Hello everybody, welcome to today's fundamentals. Hello Peter.
Hello.
So understand that BOJ took the markets by surprise earlier today, right?
True. The bank The bank maintained its interest rate unchanged at minus 0.1%. That was widely expected. The surprise came practically with the change of its yield curve control. Now, the bank up until now had a target for Japanese yields at 0.25%. Especially 10-year JGBs were targeted here. Now that upper limit has been changed. It has doubled actually from 0.25. It has reached now 0.5, half a percent. And that was considered to be practically a hawkish move on behalf of BOJ. Now the bank in its accompanying statement had mentioned that practically financial conditions have deteriorated outside the country, but they have also affected Japan as such, especially on a corporate level, and that it had to act. Also, I would be noting from the decision that the bank has highlighted that the Japanese economy is doing rather well. It's picking up. And that was also a rather optimistic note in the accompanying statement. Now, the big takeaway here is that BOJ's decade-long dovish stance has cracked. And that's an issue. We do not expect that there will be an acceleration of the monetary policy tightening over the coming months. We may see that happening maybe from April onwards. So we're talking about the second half of maybe even the second quarter of next year onwards. Now, BOJ Governor Kuroda in his press conference had stated that the move is not to be considered as a rate hike, but de facto it's a monetary policy tightening. And we have to note here also that BOJ Governor Kuroda is warning that the bank may ease monetary policy further if it's needed. Now seems to be sounding a little bit hollow. So practically we see that the market was taken by surprise. It was characteristic that JPY jumped practically across the board. It had strengthened against the US dollar, against the euro and the GBP. I would say that the monetary policy tightening could be altering the prospect of JPY, at least at the monetary level, and may ease the burden of monetary policy differentials, which BOJ had in contrast, say, for example, with the Fed or the ECB or BOE. So overall, we expect the development to provide some support for JPY over the coming weeks.
And how about the USD?
Well, the US dollar remained relatively stable with the exception of JPY. Overall, I would note that in the FX market, volatility has dropped. So we see an easing, which could also be related with the fact that the Christmas period is approaching. And we can also note that there are no major Fed policymakers which are about to make any statements. And all of that tended to ease volatility once again. There are some financial releases which could create some interest. However, for the time being, it seems to remain flat.
And how about the US stock market?
US stock markets seem to be driven by different fundamentals.
Okay.
We have fourth day where the US stock markets are in the reds. I would note that the market worries for a possible recession in the US economy are still present, and I think they are the main factor which are driving US stock markets right now. The fact that the Fed, despite an easing of the rate hiking path, continued to tighten its monetary policy, and is expected to continue to tighten even further. Increased recession worries in the market, and that drove US stock markets lower.
And what's on the calendar for today?
Well, we already had Germany's producer prices for November. They're still in the negatives, despite some slight improvement. It was very characteristic. I would also be noting that we had an improvement of Eurozone's current account balance, but both releases failed to provide any market reaction, especially about Europe pairs. So overall, they passed under the radar. Today, I would be highlighting, from the US, the construction data for November. We have the number of building permits and the number of housing starts. Both figures are expected to drop. And that's understandable in the sense that it's an adverse effect on the economy of the Fed's monetary policy tightening, given that interest rates and mortgages are becoming more expensive. Definitely, people are going to be having second guesses whether to start building or not. Other than that, I would be highlighting also from Canada the retail sales growth rate. Now, the expectations are impressive. On a month-on-month level, the rate is expected to accelerate from minus 0.5% to plus 1.5%. Should that be the case, that would imply practically that the average Canadian consumer is willing and able to actually spend more in the Canadian economy. And that would be an indication that the demand side of the economy is in a healthier state than we may have been expecting and could contribute to the economic growth of Canada. So it's a positive. Other than that, I would also be noting from the US, but that would be more oil related, the AP weekly crude oil, the EIA weekly crude, the AP weekly crude oil inventories figure. Now, should there be another considerable surplus, that would imply that the demand side of oil was not able to catch up with production levels. And thus a slack is building up in the US oil market, which could drive oil prices lower. Mind you that oil traders, besides today's AP weekly crude oil inventories, are going to be getting tomorrow EIA's weekly crude oil inventories figure. So we may see an initial market reaction today. However, I would expect that oil traders will be waiting to see whether there's going to be any confirmation in tomorrow's release as well. Also, just before the Asian session starts, we get from New Zealand the trade data. Should the trade balance be a wider deficit, that could weaken the Kiwi, as it would imply practically that the New Zealand economy suffered more from its international trading activities. And last but not least, during tomorrow's Asian session, we're getting from Japan the chain store retail sales, and should the growth rate actually accelerate on a year-on-year level, that could provide some support for JPY.
And what about the monetary front?
Well, it's an easy schedule. We already had ECB's cut senior. Other than that, I wouldn't expect much. And it's characteristic how Fed policymakers especially are absent. They were expected after the Fed's interest rate decision to make statements and actually clarify the Fed's intentions. With the exception of San Francisco Fed President Daly on Friday, we had no comments.
Any final comments?
Yeah, once again, it will be interesting to see whether we are going to be having the FX market and the stock markets be driven by slightly different fundamentals. And should we see the market worries about a possible recession in the US economy intensifying, we may see US stock markets being in the reds for another day.
Great. Thank you, Peter, for your time. And everyone for watching. Join us after a short break for technical analysis with Peter Yossi.
Welcome to the technical analysis part of the presentation for today. My name is Peter Yosef, Senior Market Analyst at IronFX. Now, in front of your screens, you have the US dollar index 4 chart. Mind you that all charts to be presented are to be of the same time frame unless otherwise stated. With no time to waste, we note that the US dollar index price action is currently testing the downward trend line, which was incepted since let's have a look, since the 21st of November. So it's a big question whether the price action will be able to clearly break the downward trend line. Should that be the case, we may see the price action initially maintaining a sideways motion in the sense that it did over the past, I would say, 48 hours. And that would be a sideways motion, a range-bound motion above the 104.5 support line, a level which was tested, aimed for here, tested here, so I'm keeping that. On the flip side, should the bears take over, once again, we may see the price action dropping, breaking the 104.5 clearly, and start aiming for the 102.50. On the other hand, should the bulls take over, we may see the price action clearly breaking the downward trend line. Yet at this point, we would also require a clear break of the 105.55 resistance line, a level which provided resistance here, support, and tested here. In which case, should the R1 be broken, then the way is paved for the R2 107.15. For the time being, once again, we maintain a bias for a sideways motion. The bias is being fed practically from the fact that the RSI indicator has risen and has reached above the reading of 50 slightly, but still just above it. That would imply a rather indecisive market in our opinion. Also note how the 20 moving average has shifted its downward movement to the upside, reflecting the recent stabilization of the index's price action. On the other hand though, slight note of warning, the bears are still in the picture, and should they take over, we may see US dollar index being driven lower. Let's have a look at Euro USD. Euro USD, which is in a similar sideways yet longer motion. At this point, it would be interesting to note that we have the sideways motion beginning since the 13th of December. For the time being, we also note that the RSI indicator is just above the reading of 50, which may also be implying a rather indecisive market and a continuation of the sideways motion. It's also characteristic that the Bollinger Bands have converged and remained rather narrow, reflecting the low volatility of the pair. Hence, overall, that leads us towards a maintenance of the sideways motion. Should, for any given reason, the bears take over, we may see the price action breaking the 1.0580 support line, a level which was tested once, twice, aimed for here, tested also to the upside once, twice. So it's pretty valid. I would be keeping that. And the next possible stop would be at the 1.0460, a level which was tested here, here, and here. To the upside, should the bulls take over, we may see the price action rising, possibly breaking the 1.0785, and start aiming thus for the 1.0935. Let's have a look at GBP USD. In GBP USD, which is currently also in a sideways motion, yet there are some slight bearish tendencies. It's characteristic how the pair continuously is testing the 1.2125, The RSI indicator is rather stable, but below the reading of 50. It's currently at 42.7, which may also imply some slight bearish tendencies for the pair. Should the best clearly take over, we may see the price action dropping, breaking the 1.2125, and start aiming for the 1.19, the next possible stop for the bears, a level which provided support here, but also provided resistance here and here. On the flip side, should the bulls take over, we may see the price action rising, breaking the 1.2345, which was tested here, and start aiming for higher grounds. Once again, main base scenario for now is that the pair may continue to have a sideways, a very tight range-bound motion, and we would like to note, or if you prefer, issue a small warning here about any possible bearish tendencies of cable. Let's have a look at USD/JPY. That was impressive. And it would be interesting to see also the market reaction at the time of the release of BOJ's interest rate decision. Drilling to the minute chart, unlocking the chart, widening it, and let's go. There it was. We had all this movement that was of 340 pips, and that was at the time of the release plus the next 1, 2, 3, 4 minutes. So within 5 minutes, the pair dropped 340 pips. That was impressive. And we can see that this motion drilling now at back to the forward chart was also reflected in Euro JPY and GBP JPY. Interestingly enough, the 131.80 seems to be able to hold its ground. So I'm keeping that level, despite the price action not actually reaching that low, but seems to be valid. Definitely the S2 and the S1 will have to be changed into resistance lines, given that the price action has moved decisively lower. Let's go hunting for new support lines. Okay, there is one here. Pretty narrow, but for the time being I would be keeping that. Let's have a look further back. Okay. And the next one could be, I would be picking this true here. Could be even a little bit higher at this level. Okay. I think we need to readjust both of them. I'm going a little bit bold here. This will be the S3, resting on this true here. And that would be the 126.30. Let's go for the S2. I would be marking this true, which also has been a resistance line. And that would be the 129.30. Let's change the colors as well. In green, please. As we have to do here. Done. Locking this in. Let's go and correct the labels as well. I know that the space between the support lines is pretty wide. Cancel. However, the intense bearish movement of the pair forces to widen the support lines. Final resistance line now being placed at 137.50. Second resistance line being placed at 135.80. First resistance line being placed at 133.90. First support line being placed at 131.80. Second support line being placed at 129.30. And final support line being placed at 126.20. Let's recheck that. 126.30, correct. Now, given that the price action has clearly broken the sideways motion it was in, has also broken, and the RSI indicator has dropped below the reading of 30. Now, the fact that RSI is below 30 on the one hand tends to underscore the dominance of the bears. On the flip side, though, it may also be implying that the pair is nearing or has even reached oversold levels and may be ripe for a correction higher, a correction which we have been seeing in today's European session. It's not a trend reversal as such for now. We're treating it as a correction as such. So we would expect the price action to drop lower, break the 131.80, and start aiming for 129.30. It's going to be interesting to see how the market reacts also on the American opening. More or less what happened with BOJ earlier during today's Asian session, late Asian session, seems to have been priced in by the Europeans already. Yet we may see a delayed market reaction with the American Open. On the other hand, should the pair be able to stabilize, I would expect it to remain between the S1 131.80 as a support line and the 133.90 as a resistance line. It would be movement like this. On the other hand, should the bulls take over, we may see the price action rising, breaking the 133.90 and start aiming for the 135.80. Definitely a correction higher is going to be needed in order to enable us actually to see whether the pair has stabilized or if it's about to continue lower as we expect, be able to draw a downward trend line which is going to be showing us the limitations of the downward movement. Let's have a look at USD CHF. The nice sideways motion with the 0.9330 being an upper boundary and the 0.9210 being a lower boundary. We expect that the sideways motion is to continue. Now the RSI indicator has dropped below the reading of 50, which may start implying some slight bearish tendencies given that it has been dropping for a while now. Should the bears take over, then we would expect the price action to break below the S1 0.9210 and start aiming for the S2 0.9090. On the flip side, should the bulls be in charge, we may see the price action rising, breaking the R1 0.9330 and start aiming for the R2 0.9450, a level which was tested to the upside right here and provided successfully some resistance, while even higher we have the 0.96 which provided resistance here. At this point, let's have a recheck on which rows or peaks the S2 and the S3 are resting. We can see the show here for the S1, a peak here and a show here and here and here for the R1, a peak here for the R2 and a peak here for the R3. We haven't checked the S2 and the S3. Let's unlock the chart, go a little bit further back just to have a recap here. Okay, practically the S2 is being placed here and the S3 here. Pretty valid, both of them. Oh, that was extensive. And also here the S2 was working as a resistance line in here as well. Pretty valid, both of them. Okay. Let's move now to commodity currency AUD/USD. AUD/USD, which by the way we had the release of RBS December meeting minutes, showed that the bank was considering a 50 basis points rate hike, and more or less though tended to pass on the radar. Let's go to the minute and have a look at the market reaction at the time of the release. No major movement. Okay, there was a rise, but not much. It relented the gains pretty quickly. Okay, back to the forward chart. Given that the price action, despite breaking the 0.6670 for a short period, was able to rise above it once again. I would expect the price action to maintain a sideways motion for the time being. The RSI indicator was pretty low. At some point it even aimed for the reading of 30, implying some bearish sentiment, yet recovered. And actually it hasn't just reached the reading of 50. And that may imply some bearish tendencies for the pair. Okay. Should the best take over, we may see the price action breaking the 0.6670, that's the S1. Mind you that the S1 was tested, aimed for here, tested here, tested here, tested here, tested even here. So it's a pretty valid level. On the flip side though, we have to note that the price action dropped and rose just above it once again. And in my opinion, that tended to imply some weakness or an expression of the bearish tendencies for the pair, however slight they may be. So should the bears take over, I would expect the price action to drop once again, break the S1, and at this point, I would expect it to go as low as the S2 0.6545, definitely lower than this true here. A clear break though of the S1 would be the first signal that the sideways motion is about to change and that the bears are slowly but steadily taking over. Let's have a look now at the possibility of a bullish scenario. Now the R1 is resting on the peaks here and here. It's 0.6795. Seems to be pretty valid. But for a bullish outlook, I would require the pair to rise, break the R1, definitely a higher peak than these ones, and start aiming actively for 0.6915. It's a long shot though, given that the price action may find it difficult, but it could happen. It did in the past. Say, for example, we can see the movement here, which covered more than the distance we're showing right now from the S1 to the R2. So it's a possibility which we should not neglect. Let's go now to commodity currency pair USD CAD. Nice sideways motion between the 1.37 and the 1.3525. But in our opinion, I think we're seeing the bullish triangle expanding. It's about to meet. Let's draw that. Okay. Locking this in. For the time being, we tend to maintain our bias for the sideways motion to continue between the 1.3525 and the 1.37. Should that sideways motion be continued and even edge a little bit lower towards the S1, then we would be seeing practically a breaking of the upward trend line, which would be signaling exactly the sideways motion is dominant and could be taking over the reins, guiding the pair. On the other hand, should the price action rise, break the R1 and start aiming for the R2, maybe even reach it. By the way, mind you that the R2 provide the resistance here, but also, let me lock this here. So it's a pretty valid level, which was tested repeatedly. Should the price action break the R1 and aim, if not even reach the R2, then we're talking about possibility that the sideways motion has been switched and a bullish outlook seems to be in place. On the other hand, should the pair drop, break the pre-mentioned upward trend line, break the 1.3525, I would definitely require a lower true than this one for a bearish outlook. So that would imply that the price action drops, breaks the upward trend line, breaks the S1, and starts aiming for the 1.3395, a level which was tested here and here. Okay, let's have a look at the Kiwi. We're having today's milk auctions, the bi-weekly, and we have the trade data of New Zealand just before tomorrow's Asian session starts. So there could be some interest here. Not much movement. The pair remains in sideways motion, in our opinion, between the 0.6440 and the 0.63. 1, 2. So that would imply sideways motion like this. Yet we have to note here that the bias for the sideways motion was maintained. However, the price action as such was within a narrow range. It's characteristic how the Bollinger Bands have converged. The RSI indicator is below the reading of 50, but actually pretty close. It's currently at 45. And that could imply also some bias for sideways motion to continue. Should the best take over, I would expect the price action to drop, break the 0.63 support line, and start aiming for 0.6155. On the other hand, should the bulls take over, we may see the price action rising, breaking the 0.6440, and start aiming for 0.6570. Now let's move out of the FX market and have a look at how US stock markets have been behaving. Especially, I would like to see Nasdaq. Yep, there it is. There's a clear downward movement. It's characteristic how the price action of the index has broken the S1 over the past 72 hours and is now aiming for the S2 10,970, which is providing some support right now. It would become more clear of the direction if we drill out to the daily chart. We're talking about 1, 2, 3, 4 days, and this is the fifth of consecutive drops. Definitely you have to change the S1 and turn it into a resistance line. Let's go hunting. I would be choosing this level. It has far more touches. On the other hand, the true here is clearer to see. I think this one's more valid. Let's keep it closer. Green, 9,930. Blocking it in. Let's correct also the labels. Starting with the R3, which is now being placed at 12,120. The R2 is being placed at 11,785. The R1 is now being placed at 11,450. The S2 at 10,440. And the S3 at 9,930. Overall, we highlight the downward trend line guiding the index, and as long as it remains below the downward trend line, we maintain a bearish outlook for the index, for Nasdaq. Mind you that the RSI indicator is also running along the reading of 30, underscoring the bearish sentiment of the market for the index. Should the bears maintain control as we expect them, then we may see the price action dropping below the 11,450 and start aiming for the 10,440. On the other hand, should the index stabilize, then we would expect the price action to break the downward trend line we have mentioned and stabilize between the 11,450, the 10,970 it is. Haven't corrected that. 10,970 support line and the 11,450 resistance line. For a bullish scenario, however improbable that may sound, it's still possible. We would expect the price action to rise, break the pre-mentioned downward trend line, which by the way is pretty steep. And also I would require clear break of the 11,450. Let's move to Dow Jones, albeit the picture should not be much different, should be pretty much the same. And it is. Okay, the price action here has shifted the downtrend line to the right, but it's still present. And especially if we drill to the daily chart, only today seems to be stabilizing somewhat. But the index is still marking lower peaks and lower truths. For the time being, we maintain a bias for a bearish outlook. But on the other hand, we would have to note here that the price action is currently testing the downward trend line. And should it be followed, then we would expect the price action to drop below the reading of 32,670 support line and start aiming for the 31,730. On the other hand, should the index stabilize, then we would expect the price action to break the pre-mentioned downward trend line, yet possibly remain above or around the 32,670 support level. Now for a bullish outlook, should the bulls actually take over, in our opinion, somewhat improbable, but still a possibility which should be covered, then we would be setting as the next target for the bulls the 33,470, with the next being the 34,275 resistance level. Let's have a look at gold. Gold's price tends to remain in a sideways motion. And it's between the R1 1807 and the 1766. There is a catch here. Now, as long as the price action remains between the pre-mentioned levels, we tend to maintain our bias for the sideways motion to continue. On the other hand, though, I note the steep rise of the precious metals price, which is also accompanied by a steep rise of the RSI indicator. An RSI indicator which has risen, distanced itself from the reading of 50. It's actually at 61.6. That's pretty high, and exactly underscores the bullish sentiment in the market currently. Should the bulls maintain control, we may see the price action breaking the 1807 resistance line level, which provided support here, yet it was broken here. And in which case the next possible stop for the bulls could be the 1840. At this point, I would like to see where the R2 is resting, as should, okay, yeah. We have touches here, testing extensive here, testing to the downside as well here. Pretty valid. I'm keeping that. So should the R1 be broken, then the next possible stop for the bulls becomes the R2, 1840. On the flip side, should the bears take over, we may see the price action dropping breaking the 1766 and start aiming for 1735, a level which provided support here and here. Aim for here. Let's also have a look at WTI. It's a quick glance. We just have a minute. Also in sideways motion. The RSI indicator is just above the reading of 50. See how practically the Bollinger Bands have leveled. Now rather flat. So we tend to maintain a bias for a sideways motion to continue between the 73.60 and the 78 resistance line. Should the bulls take over, the next possible stop, and we definitely would require a higher peak than this one, we set the 83.20, a level which provides resistance here. See how beautiful upward motion was reversed by the R2 level, stabilized initially, and then start to drop, roll down the way. Should the bears take over, a breaking of the 73.6 would be necessary for a bearish outlook. Yet we highlight as the next possible stop for the bears the 70.30 support line, a level which was tested here extensively. So that should be it from all of us here at IronFX. Best wishes for solid trading.
Everyone, my name is Emily. In today's session, we will look at news trading on economic releases. This trading strategy is appealing to many short-term forex traders. As markets move because of news, the release of economic data is often the most important catalyst for short-term movements. Basically, this trading strategy involves trading around significant forex news events, such as key economic releases from the countries whose national currencies consist of the major currency pairs. Because of the strong influence on a currency's valuation, a forex trader can take advantage of an important news release to potentially benefit from those fluctuations. There are 8 major currencies available for trading, so there is always a piece of economic data scheduled for release that forex traders can use to make informed trades. 7 or more pieces of data are released almost each weekday, except from holidays, from the 8 major most followed countries. Therefore, for traders who choose to trade news, there are lots of opportunities. As the US dollar is on the other side of 90% of all currency trades, US economic releases tend to have the most noticeable impact on forex markets. If you want to trade news successfully in the forex market, you need to know when reports are expected and understand which releases are most important under the economic conditions at the time. Generally, the most important information relates to changes in interest rates, inflation, and economic growth, like retail sales, manufacturing, and industrial production. To sum up, it's important to do your research and stay on top of economic news in order to reap the rewards. Thank you so much for watching us today, guys. Bye-bye.
So welcome everyone once again to our webinar today. We will be doing advanced moving average strategies. We're going to go through advanced moving average. You guys already know moving average. This is the most simple form of technical analysis. I personally, when I just started trading, this is the first indicator I've ever learned, and you guys will be surprised. I paid quite a bit to learn this because I signed up for one of those crazy trading courses. Nowadays, things are free. Like you guys join this webinar for free, right? Yes, so back then I had to pay like thousands to learn the moving average. I know how ridiculous that sounds. Okay, let's do the disclaimer first. So just a warning, a reminder that whatever I share in this webinar should not be construed as trading advice. It should only be taken as educational. Okay, this is only an educational webinar. The whole point of this webinars by IronFX is to help you guys grow as traders. Okay, it is to help you guys grow as traders. Right, please don't take it. There's no signals, there's no forecasting here. Okay, if you guys are waiting for the entry, the take profit, the stop loss, you're not gonna find it in this webinar because we can advise you when we think it's a good entry, but ultimately it's your choice. Another reminder, trading Forex and CFDs carries significant risk and may not be suitable for all investors, right? So do be cautious, especially if you are new here. The risk multiplies immediately, especially if you are going on leverage or margin, right? So please do be cautious. For those who are new here, do not jump into the ocean without first learning to swim. Okay, for those who don't already know me, I think I've taken you guys once or twice before, right? For those who don't already know me, my name is Cass. I am an investment analyst and a prop trader here at Everest Fortune Group. So Everest Fortune Group, we're an award-winning research firm based in Singapore. We're a fintech company. Okay, what we do, we heavily research on strategies, back testing, and we advise the banks, brokerages, financial institutions, hedge funds on where we think the markets are going. So we do a lot of research on the characteristics of the market, where it's going, how it reacts, and blah blah, and we try to find strategies to overcome that. And like today, we are going to share the strategy that you can use with moving average. Okay, so Everest Fortune Group, we've won, we're the finalists for the best Forex and best equity research for 2019, 2020, and 2021. Back to me, sorry. I personally am managing actually it's way more than 300,000 now. Okay, I'm managing quite a bit of funds, way more than 300,000 US dollars on my own personal account. That's me as a trader. I've passed FTMO twice, and I've passed my Forex funds twice. So for those who don't know what these are basically prop trading tests that requires you to have a 10% profit within the month. Okay, so I've done that consistently month after month, and hopefully as I go with you in this webinars, I can show you guys how I manage to do that 10% every month. Okay, cool, everyone, cool for now. Okay, I'm gonna move on. Okay, so our agenda for today will be to understand what moving averages are. Okay, and then we're gonna look at some of the common moving averages out there. We're gonna look at two today, and we're gonna look at the natural moving average. So natural moving average is a kind of strategy, moving average that we use here as Everest Fortune Group. If you Google natural moving average, you won't be able to find a lot of information on it, because why? I think it's kind of a bit like it's something that we invented in a way, the natural moving average. Right, so this is because I was saying we spent a lot of time back testing and looking out for strategies and patterns on the chart. So we found that the natural moving average is a strategy that works very well on when it comes to trading. Okay, so just bear with me. We will get to the natural moving average towards the end of the slides or midway of the slides. And lastly, we'll be identifying reversals with the natural moving average. And if we have enough time, right? If we have enough time, we will be moving to trading view so that I can show you guys ultimately live examples of how this will work. Why? Because look, I love doing this webinars for you guys, right? It's a lot of theoretical stuff. It's a lot of textbook stuff. You know what I mean? So I can tell you what the moving average, the definition of the moving average. I can tell you the calculation of the moving average. Blah blah blah. I can tell you so much about the moving average. But ultimately, if you don't know how to apply the moving average, it would still not be useful. You know what I mean? If I give you a pen and you don't even know how to do what to do with the pen, you don't even know how to write, that pen will just be obsolete to you, right? So ultimately, we will try to go to TradingView if we have time to kind of apply the moving average and see how it works. Okay, so before I move on, can you guys just let me know in the chat box if any of you use the moving average to trade? Have you ever heard of it, at least, the moving average? No, no one? Okay, thank you, Lola. No one has ever heard of moving average. That's the most, I try but don't understand. Okay. Yes, we got a lot of yeses. Yes, this is not unusual because, again, I said it's one of the most common indicators. I only look at it at a very basic level. Yes, me, myself, personally, I only use moving average on a very basic level, and I'll show you guys why later on towards the end of the webinar. Okay, so moving average, when I just started using it, I learned it very simple. Okay, if price, let me grab my pen so I can show you. So when I went for these crazy courses where I had to pay so much money to attend, the guy basically taught me that when price crosses above the moving average, you should get in for a buy. Okay, when the price goes below the moving average, you should get in for a sell. Okay, that's what I learned about the moving average. It works sometimes, doesn't work sometimes. Most of the time, it doesn't work that well. Okay, that's why you should never use, although today's topic is moving average, I must say, because like every week we'll go through different topics, right? Sometimes we'll go through moving average, Ichimoku, trend lines, support resistance, whatever it is. You should never use one technical indicator on its own to look for entry, stop loss, and take profit. It should never be only one to look for your analysis. It should always be a combination of all things to look for your analysis. And I want to use this example, which I am sure you guys heard when I took you the last time. It's the same as like you're going to a mall, you're buying a pink dress. Okay, you see the pink dress, you don't know if it's good or not. So if enough people tell you that the pink dress is nice, you are going to buy it, right? But if everyone keeps telling you it's a no, you're not going to buy it. So it's the same as like you going to your dad, hey, does this dress look nice on you? And then your dad goes like, yes, it does look nice on you. And your mom says, yes, it looks nice. Your sister says, yes, it looks nice. And your brother says, no, it doesn't look nice. Okay, so similarly, when we're looking for trades and setups, we need different technical analysis to give us data and, well, not opinions, but more like analysis, right, of where those technical analysis think price is going. So if enough technical analysis is telling you that price is going up, you are going to get in for a buy. If enough technical analysis is telling you price is going down, you are going to get in for a sell. Okay, right? So moving average is just a tiny part of your entire analysis. Okay, it is maybe your dad. When you ask your dad, hey, is this dress nice? Moving average will tell you yes or no, it's nice or not. That means moving average will tell you it's a buy or if it's a sell. Okay, support resistance will be your mom. Okay, trend lines will be your brother. Okay, and so on and so forth. Okay, so again, moving average is just a tiny part. So let me explain what moving average is in a very textbook definition. Right, again, I will go through all the textbook stuff, all the theoretical stuff with you, but ultimately you need to be able to grasp. Hey, Fauzan, welcome to the webinar. You need to be able to grasp how to use this indicator, the best way to use this indicator. You can know this in and out, but if you don't know how to apply it, there's no use. Okay, so let's go through the textbook definitions and all a little basic backstory on the moving average, and then we will try to go into applying it. Okay, so a moving average is a technical indicator that market analysts and investors may use to determine the direction of a trend. Okay, it sums up the data points of a financial security over a specific time period and divides the total by the number of data points to arrive at an average. Okay, it is called a moving average because it's a continually recalculating based on the latest price data. Okay, to put that in the most simple terms that I can think of, right? That is the most textbook definition you can think of. Let's say you see all these candlesticks, okay? If you put your moving average settings to 5, it's basically taking the price of the last 5 candles and dividing it by 5. So it's basically the average of the 5 last candles. If you put the settings at 20, it's the average of the last 20 candles. If you put it at 100, it's basically the average of the last 100 candles. That's why you can see most of the time the moving average is there a best moving average? You know, when it comes to technical analysis, I don't think there's ever a best of anything. It's whatever works the best on whichever time frame and whichever charts you are looking at. So I'll give you an example. There are certain pairs, there are certain forex pairs on certain time frames works well on a strategy that we have found here at Adverse Fortune Group. It's called the Nike Tick strategy. That's a totally different webinar. Okay, we found that that strategy works very well on gold. Okay, but that same strategy does not work very well on AUD USD, for example. Okay, so there's never a best of something. There's always which works best at that particular time frame and that particular pair and that particular instrument. Okay, that's why backtesting and research. I have to say, I don't think trading is hard. I think it's a very simple thing. You can probably teach it to a 12-year-old and they will be able to get trading. Like, what's so hard? You just buy and you sell, you put a stop loss and you take profit, right? It's not hard. The hard part is the time consuming part is actually backtesting and learning how to trade. That is the time consuming and the hard part, to be able to grasp and be able to collect all this data. Okay, so that I think is the harder part when it comes to trading. Okay, I hope that answers your question. So okay, let me continue with the definition of moving average. So analysts use the moving average to examine support and resistance by evaluating the movement of an asset's price. A moving average reflects the previous price action movement of a security. Analysts and investors then use the information to determine the potential direction of the asset price. It is known as a lagging indicator. Yes, moving average is a lagging indicator because it trails the price action of the underlying assets to produce a signal and show the direction of a given trend. Okay, I'll tell you guys, when I started using the moving average, I was not making a lot of money. This was when I just started trading. Okay, why? Because the moving average is a lagging indicator. It gives you information that is slow. Okay, so in the beginning, when I was losing a lot of money in trading, I was thinking to myself, this indicator is so dumb. Why is anyone even using this indicator? You're only right like 4 times out of 10 times or 3 times out of 10 times, whatever it is. And the times that you are right, you don't even make that much. When you lose a lot, okay, whatever it is. I was blaming the indicator. So now that I've learned as I grow as a trader, it's not that the moving average is completely useless. It's just like, maybe right now I find that I really love the Ichimoku cloud indicator, right? So to me, the Ichimoku cloud indicator is a Ferrari, and the moving average may be like a maybe a mom van, for example, maybe a van. Okay, so if you were to race, obviously the Ferrari is going to win, right? But it doesn't mean the van is completely useless. The van is still going to get you from point A to point B. It's just that the van is going to get you from point A to point B. It's more fuel efficient, maybe. It gives you more room. You can fit more people in the van compared to the Ferrari. So every indicator has its pros and cons, okay? So the moving average as well has its pros and cons, even though it is a lagging indicator, and we will look into that. Okay, so a moving average is a technical indicator that investors and traders use to determine the trend direction of securities. It is calculated by adding up all the data points during a specific period and dividing the sum by the number of times periods. The average moving averages help technical traders to generate trading signals. Okay, again, the general thumb of rule is if price breaks above the moving average, you are bullish. If price breaks below the moving average, you are bearish. But in this case, you can see how it didn't work out here. It wouldn't have worked out here because price was moving sideways. Okay, so that is the definition. The common moving averages out there. Today, we are going to look at 3 kinds of moving average. One is, oh, sorry, I don't know why I put the weightage moving average in there. We're not going to be looking at weightage. Okay, we're going to be looking at the simple moving average, which is the most common moving average out there, and the exponential moving average. Okay, so this is basically the calculation. When I look at it, I don't like, I know if I refer to my notes or whatever, I know what it means, but just one look, I wouldn't know. And that's totally fine. Again, more importantly, is how you apply the indicator. More importantly, you don't know how your clothes are made, right? You don't know how electricity works, right? But you know how to turn on the switch, right? You know how to turn on the switch to use the electricity. So the same, this looks very complicated. More importantly, we need to know how this works, okay? So let's start with the simple moving average. The simple moving average is a straightforward technical indicator that is obtained by summing the recent data points in a given set and dividing the total by the number of the time period. So trader use the simple moving average indicator to generate signals on when to enter and exit a market. And SMA is backward looking, and it relies on the past price data for a given period. It can be computed for different types of prices. So for example, you can get it from the high, the low, the open, and the close, okay? In financial markets, analysts and investors use the SMA indicator to determine buy and sell signals for securities. The SMA helps to identify support and resistance price to obtain signals on where to enter or exit a trade. When generating the SMA, traders must first calculate this average by adding prices over a given period and dividing the total by the total number of periods. The information is then plotted on a graph. So the formula for simple moving average is written as, this was a calculation. Let me go back to the last slide. So yes, this is basically a calculation, okay? It's basically, let's say you choose 5, right? Let's say you choose your period as 5. So let's say the first price was 1, 2, 3, 4, and 5. Okay, you add 1, 2, 3, 4, and 5 together, you will get 15. Okay, and then you take 15 and you divide it by 5, you will get 5. Okay, so that's basically how you calculate the moving average. It's just the average of the period that you chose. Okay, it's as simple. It's basically the name. It's just the average. And why is it called moving average? Because it's literally a moving average. Okay. So A is the average in periods and N is the number of periods. Okay, everyone good? Gonna move on to the exponential moving average. Okay, so the exponential moving average, which gives more weight to the most recent price points to make it more responsive to recent data points. So the exponential moving average is not as lagging compared to the moving average, okay? An exponential moving average tends to be more responsive to recent price changes as compared to the simple moving average, which applies equal weight to all price changes in the given period. When calculating the exponential moving average, the following 3 steps are used. Let me show you the calculation again. This is the one, C minus P times 2 over N plus 1 plus P, okay? Okay, so yeah, 3 steps that I use are, number 1, you calculate the simple moving average for the period. The EMA needs to start somewhere. So the simple moving average is used as the previous period's EMA. It is obtained by taking the sum of the securities closing prices for the period in question and dividing the total number of periods. Okay? it's similar to the simple moving average, but you take the price from the close. Okay. Number 2, you calculate the multiplier for weighting the exponential moving average. So the formula for calculating the multiplier is as follows. Multiplier equals to 2 divided by the selected time period plus 1. So for example, if the time period is in question is 10, the multiplier will be calculated as 2 divided by 10 plus 1. Okay, so the 2 divided by x plus 1 is fixed. I'll just quickly go back. I know this is, so 2 divided by n plus 1. The n is the variable that changes, okay? And then you'll get your answer. So the last step is to calculate the current exponential moving average. The last step calculates the current EMA by taking the period from the initial EMA until the most recent time period using the price multiplier and the previous period's EMA value. It is computed using the following formula. The current EMA equals to, okay, that formula I showed you guys a while ago. Okay, it's basically the calculations. So what is the difference between the EMA and the simple moving average? Okay, the main difference between the two technical indicators is the sensitivity that they place on price changes. So the exponential moving average tends to show more sensitivity to recent price point changes. This makes the EMA more responsive to the latest price changes. The formula for calculating the EMA tends to be complicated, but most charting tools make it easy for traders to follow an EMA, okay? In contrast to the simple moving average, applies equal weighting to all observations in the data set. It is easy to calculate, being obtained by taking the arithmetic mean of prices during the time period in question. Okay, everyone okay with the definition of simple and exponential moving average? Don't worry. Don't worry, when I just learned it, I'm just like, oh, this is so dry. Don't worry, okay. I was there once before. For those who are new here, for those who already learned this, right? For those who already learned this, you're just like, okay, I already know this stuff, right? Then it's how we apply. Okay, so I'm gonna teach you guys the natural moving average, which is what we use a lot here at Everest Fortune Group, okay? Oh, by the way, if you guys are wondering why I'm from Everest Fortune Group, I probably forgot to mention in the introduction. It's because we have a special collaboration, okay? We have a special collaboration to bring you guys these webinars so that you guys can grow as traders. For those who are already profitable, more information to learn, just a different point of view. For those who are still learning and growing as traders, I'm happy to help you guys be even better, okay? So the natural moving average. When you go on Google, when you look for books on moving average, you always hear people saying, oh, the 100 moving average, the 200 moving average, the 50 moving average, the whatever moving average. My question is, can you guys, for those who use moving average, can you guys let me know what number or what settings for the moving average do you usually use? Is it the 50, the 100, the 200? I see Lola saying that she uses the 10, 60, and 200. Anyone else uses a different number? Okay, so Andrej, I hope I'm pronouncing your name correctly, uses the 50 and 100. We've got Kurt using the 50 and the 200 as well, only because that's what a video set to use. Okay, Kurt. I was using the 50 and 100 as well. It's called the golden cross and the moving average. Okay, right? I was using that as well because, yes, I saw a video that told me to use. Actually, no, it was from that course that I went, the one where I paid a few $1,000s to learn about moving average, right? That guy told me to use 200 and 100. I can't remember what it was. Okay, Philip uses the 15, Kingsley uses the 50, the 100 and 200, and Ola uses 7, 14, 89 and 200. Okay, very very uncommon numbers. Okay, so as the answers are coming in, I see a lot of people saying 50 and 200. Why? Because this is commonly believed to be the best settings to use. Okay, I'm not saying it's not good settings. It's just that here at Everest Fortune Group, we have noticed that, I mean, think about it. Okay, think about it, right? Let's say you are going to a party, right? The theme of the party is Hollywood theme, right? You have this beautiful, I know I use dresses as a lot of my references, okay? You have a very beautiful you have a very beautiful mini skirt, for example, and very tall stilettos, very tall heels. That short skirt is something you usually use when you go clubbing, right? When you go to the club, you use that very short skirt or whatever it is. But today the theme is Hollywood. Okay, the theme is Hollywood. So you expect really big, gorgeous ball gowns, fancy wavy hair, whatever it is. Okay, the dress will not, the outfit that you choose, which is a short skirt and maybe spaghetti strap, whatever it is, does not fit the theme of Hollywood theme. Okay, it does not fit the theme. So therefore, it's the same when it comes to trading. We don't believe that there is one number that fits all charts and all time frames. So we actually, when you're using the moveset natural moving average, we actually adjust the setting to fit the chart rather than the chart fitting the setting. Do you know what I mean? Right? I understand 50 and 200 is a very common number when you're using the moving average. I personally was using the 50 and 100, but the 50 and 100 does not work on all charts, and it does not work on all time frames and all pairs. So the 50 smoothen 10 LWMA low price. Is this okay? Is that a setting that you use, Henry? Right, so we've got different answers. So which one do we use? We have found that the best settings to use when it comes to moving average is to use the moving average that fits to the charts. Okay, so let me try to grab my pen. I actually tried to use a pen. I can't really find the pen. Okay, draw. I think this is it. Okay. Here. Oops. Just give me a sec. Let me just clear out draw. Okay. Can you guys see that this is what people usually use, right? People usually use the 50. When we look at the charts, the 50 looks like this, okay? The 50 looks like this, right? But you can see that there are times where price doesn't really touch the charts, okay? It doesn't really touch the charts, right? So a lot of times when we're using moving average, a lot of traders, okay, there's two very simple and known ways to use the moving average. One is when price breaks above the moving average, you enter for a buy, right? When it breaks below the moving average, you enter for a sell. Okay, that was one of the most common, the easiest thing, the most common thing you hear about the moving average, right? Okay, the other way is to, when price comes back to that moving average, the moving average itself works as a form of support and resistance, okay? The moving average itself works as a form of support and resistance. So every time price comes here, the trader will look to get in for a buy here, look to get in for a buy. When it comes here, look to get in for a buy. It goes up, it comes back, look to get in for a buy, okay? So that is the other way to use the moving average. Give me a sec. Okay, that's the two ways. So dynamic and support resistance. Yes, correct. That's correct, said Henry. Okay, Karim is asking what's the best moving average to trade on, the 50 minutes or the 1 hour? Okay, when it comes to moving average or any kinds of technical analysis, again, I need to remind you guys that the best moving average that you should be using is the one that fits perfectly onto the the one that fits well on the chart and is effective on the chart. So I would say the moving average is effective on both the 15 minutes and the 1 hour, depending on the settings. Okay, it depends on the settings, right? It can work on all charts depending on the settings. Okay, so let me just erase everything. Let me just erase everything. Sorry, I need to just give me a sec. Okay. Okay, so this is the 50 and this is the 46, right? Can you guys tell me, if you were to get in for the bounce, which charts would you prefer using? Just give me a while, Karim. I'll answer your question in a while. If you were using the strategy, right? If you were using the strategy where you wait for price to come back and you get in for a buy here. Every time price comes back and you get in for a buy here, which charts would you trust more, A or B? Would you trust chart A or chart B more? Okay, yeah, definitely the 46. But 46 is not a common number used for moving average, right? It's just a random number that we chose. Okay, I see someone saying B. Okay, actually why we choose A is because, remember saying the moving average works as a support and resistance, right? So every time price comes back to that support, you expect to get in here for that buy. But can you see here? This is the exact same charts, okay? It is the exact same charts. It's just that the settings was tweaked. The settings for both moving average was changed a little. This one, whoops, let me go back. This one is the 50 and this one is the 46, okay? We manually went into the settings and changed it to the 46. Okay, we manually went to the settings and changed it to 46, and we can all agree that the A looks better when we're looking for entries. Okay, A looks better when we're looking for entries. Why? This is the exact same chart. If we were to use this chart, if we were to use B to get in for a buy, right? Think about it. If we were to use B to get in for the charts, B didn't even touch the moving average and we would have missed this buy entry here. Whereas here on the A charts, okay, price nicely touched the moving average and you enter here for the buy. Okay, so this chart is more accurate. We can safely conclude that the A chart is more accurate compared to the B chart. So whenever we are using technical analysis, to make our decision making, we need to take note, okay? We need to take note that our only job as traders or analysts is to try our best to find the most accurate information, okay? To try our best to find the most accurate as possible information. And there's no black and white written anyway to say that, oh, you must use it this way, you must use it this way. The best way to use something is whatever way that you find is effective, okay? So we have found that this is the most effective way to use it, okay? Okay, let's, let me just remove all the drawings, sorry. Okay, bonus, combining moving average with other strategies. Sorry, this is not the one we're supposed to identify reversals with the natural moving average, and that is exactly the strategy that that is commonly used, which is to get in for the buy. Whenever price comes to the moving average area, you get in for a buy. Whenever price gets into the moving average area, you get in for a buy. The support and resistance. Okay, so looks like we still have about 20 minutes. We can do the bonus, which is combining moving average with other strategies. Okay, so let's move on to the live charts, right? Let's move on to the live charts so that we can apply what we learned today, okay? Give me a sec, let me exit, let me share a new screen. Since we're doing a practice, we might as well try to find a setup. Can you guys, if you guys have any requests for any a particular pair or instrument, do let me know in the chat box, right? If not, I'm just gonna randomly choose one. Okay, I'm just gonna randomly choose one. Let's do maybe sugar. Okay, that's a really, any Forex pairs? Sugar is a very uncommon. Okay, I think sugar is a future, it's usually a future chart, right? Okay, let's see how well, maybe let's do GBP NZD instead. Okay, let's do GBP NZD instead. Let's try to do a Forex pair, because one thing about the sugar chart, we can do it, but because it depends on the chart you use as well, right? This chart particular, I wouldn't want to use this because there's a lot of gapping. It's probably because it is not a 24-hour chart. This chart is closed. Okay, let's try to do GBP NZD. I see a request on BTC USD. Would love to do that. I am a crypto trader myself. Okay. Okay. One thing about the moving average that you guys might want to know is that the moving average works very well on trending markets. Okay, it works very well on trending markets. You can see here that market is kind of going sideways. There's a little bit of a triangle going on, right? There's a little bit of triangle going on, but it works better when it is ranging. Okay, it works better when it's ranging. Okay, so there's two strategies that I will be showing you guys. The first one is to use correlation. Okay, look at the charts that we chose. We chose GBP NZD. Okay, we chose GBP NZD as the chart. So can you guys let me know in the chat box, do you know what pair is closely related to GBP NZD? What Forex pair is closely related to GBP NZD? There is correlations with pair. It's the same with USD, the Canadian dollar, and oil. Why? Because Canada is a very big oil producing country, right? So the GBP is very closely related to, yes, thank you so much, Kurt. Yes, the GBP NZD is very closely to, number one, the GBP AUD, because the AUD and the NZD is very correlated. Okay, for those who are not sure, you can just go currency correlation strength. Okay. Just go to my FX book. My FX book is a good one. Okay. This is where you find correlation. Okay. Let's say you're looking for the GBP, EUR, actually the GBP NZD. Okay, the GBP NZD, when we compare it to the EUR NZD, EUR NZD, you can see that there is 89.6% correlation. It's very, very correlated, okay? Because the GBP is very related to the EUR and the AUD is very related to the NZD, okay? So one way we can use the moving average strategy is to use correlation, but then again, you can use correlation with a lot of things. How you do that, you see this plus button, right? You can plus, click on that, add the correlating pair, which is the GBP AUD. Okay, we're gonna add that in. This is not the one that I wanted. GBP AUD. Sorry, just give me a second. I'm trying to add in another chart. Okay, so you put it as new panel, new. Okay, and it will show below it, right? It will show below it. Just go into settings and change that into. Just change that to. I want to change this to a candlesticks pattern chart. Okay, these settings are tricky. It doesn't matter. You can see the price action going on here. Okay, now we're going to pull out the moving average. We're going to pull out a moving average. Why? Because this is our topic for today. So we'll be focusing on the moving average. Okay, on this, we'll be pulling out the moving average as well. Why isn't this coming off? Okay, guys, I think it's much better if I just open another screen. It'll be much faster if I just open another screen. Usually I can compare both charts. It's just somewhere in the settings that I don't see today. Okay, so one of it is GBP NZD and the other one is GBP AUD, right? Okay, we're gonna go into charts. I'm gonna get rid of this since it's not helping. And we're gonna see how correlated this pair is to each other. Okay, we're gonna see how correlated this pair is to each other. The more correlated it is, the more we want to use it. Okay. I'm gonna get rid of this. Okay, again, this chart was not the best to chart on anyways. Okay, we want to see what is happening on both charts. We want to see what's happening on both charts. So this is the GBP AUD and this is the GBP NZD. You can see that from here, price broke kind of like the moving average to the downside. So naturally you want to enter for a sell, right? Just using the moving average, you want to enter for a sell. But you can see from the past, every time it broke the downside, it was a fake out. It comes back and fakes out. It comes back and fakes out. So what can we safely conclude? It breaks here, it goes up, didn't really give you a good move, and it came back down, broke it. Okay, you would have been able to caught very small moves. What does this tell me when I'm looking at it? It tells me that the moving average doesn't work very well on GBP AUD on the 1 hour time frame. Okay, let's look at how it works on the GBP NZD. By right, price is supposed to break, go back. Every time it comes here, it's supposed to bounce off. It doesn't bounce off. It keeps breaking and keeps doing fake outs. It keeps doing fake outs, keep doing fake out. It means this is not an effective, moving average is not an effective indicator on the 1 hour on a GBP NZD and the GBP AUD at this current point of time. Okay, maybe in the future it'll work well, but at this current point of time, today, okay, today it does not work well. Okay, so let's quickly go and look at another pair, USD AUD maybe. Okay, and the USD NZD. Okay, I just want to quickly show you guys an example of correlation. Okay, the first thing I'm going to do is change this to the moving average, natural moving average. So how do you look for the natural moving average? What is the settings? I think someone was asking me earlier on, Karim was asking me, what is the setting? So we don't have a specific setting because again, we are adapting to the charts, right? We don't have a fixed setting, right? It's not 50, it's not 100, it's not 75, it's not 200. It is not a fixed setting. So the settings that we go for is usually using Fibonacci levels number. So the Fibonacci level, that is the 28, okay, the 28.6, the 32, the 50%, the 61.8%, and the 78.6%. Okay, so these are some of the Fibonacci numbers. We try to use this number and we see how well it works. Okay, so let's say we move it to the 28%. Let's see how well it moves. Okay, do you guys think this is a good number to stick on? Okay, Price came here, it broke out, did a fake out, came here. By right, when it comes here, it's supposed to bounce. Comes here, it's supposed to bounce. Okay, no, I don't think this is very good settings. So we need to adjust the settings again. We need to adjust the settings until we find a good settings that works well on our charts. So let's try the 32. 32 is not a good one. 50. Okay, I think 50 will not work. Let's try 61. Nope, doesn't work very nicely. You want to find a setting where price was respecting for a while, and that is the settings you're going to be using. Okay, let's try maybe 70. Okay, I think 70 is not the best. Okay, again, I'm just randomly choosing number because I'm trying to find a number that fits well. The thing about natural moving average, because there's no fixed number that you should be using, you kind of just need to experiment and tweak the settings to yourself. Okay, why do I think 70 is a good settings for AUD at USD AUD at this current point of time? Because why? Okay, you can see price broke here. It came here, it reversed. It came here, it reversed. It came back to the resistance, it reversed. Okay, so just using these settings alone, we can safely say that price respected these settings. Okay, only on the first time it finally broke. Okay, it broke, it broke, it broke. It came here. Maybe the settings can be tweaked a little to make the moving average go under. Okay, but that will take a bit of time. We don't have a lot of time left. So let's say I've tweaked the settings to a better number and price was nicely respecting this moving average. Okay, maybe the correct settings would be like 72 or 75, whatever it is. Okay, it comes and reverse here. It breaks this, comes, respected this, turn back, broke, came here, respected this area, bounce, broke, respected this area, bounce, and then it stopped respecting. Okay, so my whole point of showing you this is that you need, when it comes to natural moving average, you need to find the setting that fits well to your charts. Yes, it will take a bit of time to find the correct settings, but you can just randomly jump and hopefully land on one that works. You can start with 10, 20, 30, 40, 50, 60, 70, 80, and see which one works well. So let me try 80 to see. See, the more I adjust, the more nicely it moves naturally. Okay, the more nicely you can see that price came here, reversed nicely. This part doesn't respect so nicely anymore, reversed, reversed, and here it breaks. Okay, so if this continues, if this moving average, this natural moving average is still working good, we expect price to do this, come back and retest nicely here, and then we can get in for a sell. Okay. So the other way, how we use correlation, right? The other way, maybe I can try 88 because that is a Fibonacci level. At 88 doesn't work well. Okay, maybe it's a 70. 70 was probably the, or 80 was probably the best as of now. Okay, now we go to NZD USD. You pull out the exact same settings, which is the 80, and see if that works well. Okay, let's get rid of everything else. Trying to show you, okay, here price respected the 80. This part didn't respect, this part it respected, this part respected, it respected, didn't respect here, didn't respect here. Now it's not respecting. It just means 80 is not the correct settings for NZD, USD, NZD. Okay, that means we need to tweak it again until we find a better one. Okay, 100 is not the settings as well, maybe 120. Okay, 120 looks like a little bit better settings. right? It looks like a little bit better settings. We need to find the best settings for the charts. Why? Because we are using this to get our entry, right? You know what I mean? We are using this to get our entry. And how I'm using correlation. Okay, we only have 5 more minutes left, so I don't really have time to slowly look for the perfect moving average settings. Okay, it does take some time. Okay, let's say the moving average, I'm just gonna draw a fake moving average. Okay, let's say you found the perfect settings, okay, and it's respecting price. Okay, so why I use correlation whenever, okay, let's say I found the settings and this is the moving average that I think fits best. Why? Because price came here, bounce, came here, reverse, came here, bounce, came here, bounce, came here, bounce, came here, bounce. So when price comes to my moving average again, I expect it to bounce again. Okay, so why am I using correlation? Because if I expect price to bounce, it means that I expect price to be a buy, right? My bias right now is a buy. Okay, the bias right now is a buy. Okay, so now what I do is I go back to my correlated pair, which is the AUSD, AUD. Oh, by the way, the thing that we usually use is actually the AUD, USD, and NZD USD, but I already typed it, so it doesn't matter. Okay, let's say we have found a very nice moving average to use as well. Okay, and it looks something like this. It looks something like this, for example. Okay. Something like that. So when we're looking at the USD AUD, we are also biased that price is going to come here and bounce. Similarly to USD and NZD. So you're using the correlation on both the charts because, again, when you go to the correlation, you can see that they are, for example, 80+% correlated. They're 87.1% correlated. So the USD AUD and the USD NZD is a very correlated pair. So if your bias for one pair is a buy, the other pair should also be a buy. Okay, do you get what I mean? So that's how you combine correlation with moving average or any other indicator to confirm your bias. Okay, because you know when I am trading, I think I have won half the battle once I have established the first question. So the first question I always have to ask myself, and I hope I get it right, is price moving in a downtrend or uptrend? Am I getting in for a buy or a sell? Okay. If you got the direction correct, I really think you would have won half the battle already. Imagine you think it's a sell, but actually it's a buy. It's a very, very long buy. So using correlation and moving averages, you are able to confirm, you're able to confirm the direction that you want to get in on. Are you getting in on a buy or are you getting in on a sell? Okay, that's one. The second strategy that I'm going to show you guys. So the first one is correlation. The second strategy I am going to show you guys is the usual strategy that I use on a daily basis. One is to combine, right? Combine the moving average with support resistance, Fibonacci levels, the moving average, other indicators, and chart patterns. Okay, so the first thing I'm going to do is look for trend direction. I do see price moving on an uptrend. If anyone else sees anything else, do let me know. I only see price moving on an uptrend. In fact, it is moving in an ascending channel. Okay, it is moving in an ascending channel. Okay, now I am going to highlight some support and resistance. Okay, there is support and resistance here, right? There's support and resistance here. Okay, so right now looking at a channel, I am biased that price is going up. Okay, I'm biased that price is going to go up. Why? Because there is bullish momentum. Two, I think price is going to go up here. Why? Because there is a horizontal pullback level here. Okay, three, why do I think price is going to go up from there? Because when I pulled out the Fibonacci, right, there was the 61.8 lining up on my support, okay, which is giving strength to my support. Okay, that's three, why I think price is going to go up from here. Four, why I think price is going to go up is because when I pulled out the moving average indicator and I used the natural moving average and I adjusted the settings, okay, Guys, again, we don't have time to find the exact settings for these charts. That is just, you have to toggle with it, right? When I pulled the moving average indicator, there was a moving average here. So I expect price to move down here and bounce here. So the other strategy that I'm trying to show you guys is to combine the moving average with other technical indicators to get an even more accurate analysis. It's the same concept as the pink dress that you wanted to buy. You want to buy a pink dress, you don't know if it's good or not. So you ask your mom. Okay, your mom says yes, your dad says yes, it looks good on you. You ask your grandmother, everyone says it looks good on you. There's only one guy who says it doesn't look, it's your brother. Your brother says it doesn't look good on you. But you're thinking, so many people told me it looks good. I don't care what my brother thinks. I'm gonna get the dress anyways, okay? So right now we've got so many things telling us that this is a buy, right? You are going to get into this buy because there's enough reason to believe that price is going to bounce from here. Okay, so you use moving average with everything else, combining with everything else to get an even more accurate analysis. Okay, one thing you need to remember, you need to drill it very hard into your brain, deep into your brain, is that your only job as a trader is to find the probability of whether a trade will work or not. Okay, you want to get in here for a sell. You are now going to use technical analysis, fundamental analysis, whatever it is analysis you have, maybe your gut feeling, maybe whatever it is, whatever you can use to find how probable is price going to come here and reverse from here. Okay, using technical analysis, you will be able to narrow down or give yourself a rough percentage of whether a price is going to work. Because let's say you have established that an analysis is, oh, there's an 80% chance that this is going to be a buy. That means you get in, right? But you see, it's totally different. I think a lot of laymen have a conception that trading is gambling. It is not gambling. It is calculated, collected data and risk management. Okay, the difference with gambling and trading is based on very high probability. Okay, whereas gambling, for instance, you go into the casino, you play blackjack, it's a 50-50. It is a 50-50. Okay, you play roulette, it is a 48% chance of winning. Playing blackjack is a 50% chance of winning. Playing the slot machines is a, I don't know how many percent, maybe 3% chance of winning. Playing, I don't know what other games there is in the casino. I can't even think anything, okay? The probability is against you. Why? Because the probability is so low, chances of you losing to the casino is higher. The casino always has the upper hand to win you. But when it comes to trading and the charts, you get to use technical analysis and all these tools to narrow down how probable a trade is. If it's probable, get in for a trade. If it's not probable, don't get in for a trade. Save the money and don't get in for a trade. Okay, so that's all. Yes, I would agree. I really love poker. I think poker is a game of skills, right? I would agree. Trading is kind of like poker, right? I would have to say poker also has a lot of luck involved in it, right? But trading is maybe a lot more skills and research. Okay, so that's all I have for you guys today. I will catch you guys again. Thank you so much. I'm glad you enjoyed this class. I'll catch you guys again next week. Thanks for attending. Take care, everyone. Hope you learned something. Yes, more importantly, hope you learned something. That's the most important thing here. Hope you guys eventually will be able to grow your accounts into millions and millions. Okay, so I'll catch you guys again. Bye, guys. Thank you so much. Are you or Desmond?
Everyone, today we'll be looking at another trading strategy known as hedging. Hedging is a risk management strategy that is used to offset losses by taking an opposite position. The two positions should both remain open without cancelling each other out, and they can be established just before the release of a key news event. Hedging against risk means using financial instruments or market strategies to offset the risk of any adverse price movements. In other words, investors hedge one investment by making another trade in an opposite direction. The reduction in risk provided by hedging usually means a reduction in potential profits. Basically, hedging is a technique that is meant to reduce a potential loss and not maximize a potential gain. If the trade you are hedging against is profitable, you also usually reduce your potential profit. However, if the trade loses money and your hedge was successful, you will have reduced your loss. Bear in mind though that every hedging strategy has a cost associated with it. So, before you decide to use hedging, you should consider if the potential benefits justify the expense. It's important to remember that the goal of hedging isn't to make money. The purpose of hedging is to protect from losses. The main advantage of hedging is that the neutral position is resistant to sharp market swings that generally take place after a significant market event occurs. Thank you for watching. Hope you found our video interesting. In our next video, we'll be looking at another trading strategy.